Good morning, everyone, and thank you for joining us for this week's economic update with Dr. Marcy Rosell. We also have a special guest this week. His name's Matt Canfield, and Matt he's a Senior Vice President of Relocation and Affinity Lending from TIAA. And we've asked Matt to join us because we had a lot of really great questions about mortgage changes that have happened this week. And I wanted Marcy to have the opportunity to comment on the economic impact of those as well. So we're going to start off with Marcy and then come to Matt, and then we'll circle back at the end. But I wanted to just quickly also, housekeeping-wise, this is a 30-minute webinar. We are doing these every Friday for the next few weeks. If you do want to send questions, you can send them ahead of time to j.edgerton@leadingre.com. You can also post them in the questions box here, and we will do our best to answer them this week. And if we don't get to them this week, we will try to address them next week. That's, again, why we included Matt this week, because we had so many good questions next week. Do, of course, remember that we are trying to focus specifically on the economy, but we are recording these sessions, and they are going to be available in the follow-up email. The link to them will be available in the follow-up email you'll receive tomorrow, and they are also living on the Vimeo site. That's the vimeo.com/leadingre. So those are available to you as well. With that, I'm just going to go ahead and, again, welcome our guests. And Marcy, I think the first thing that we probably really need to address is the new unemployment numbers that came out yesterday and today, and then obviously what that means for us and for the economy in general.
Sure. Well, the big news this morning was that the unemployment rate for March was released, and the figures for March, which by sort of understanding how they're collected, only capture what happened really in the first 3 weeks of the month, showed that unemployment was already picking up even before the massive social distancing measures were put into place for most of the US. So we saw in March that the unemployment rate ticked up to about 4.4% last month, and there was job loss to the tune of about 700,000. So even before the measures rolled out nationwide, you were already seeing stress in labor markets. To get a more current sense of what's going on, we really do have to focus on those weekly initial claims for unemployment benefits. And what we saw last week when we talked was that they had gone up by 3 million, and this week they went up by almost 8 million. So that brings the sort of best guess of the current job losses right now to something close to 10 million jobs lost over the course of just the last 2 to 3 weeks. We know that there's a backlog in accessing those websites, so the numbers will continue to be not in the 100,000s like we're accustomed to, but more like in the millions. So this is going to be, as we said, sort of over our last few calls, what's strange about this is that in a typical recession, the job loss is the last thing to happen. In these circumstances, the job loss is the very first thing to happen because you've essentially shut down by government fiat a certain sector of the economy. So that's what makes this so different. I almost wouldn't even call it a recession. So you're going to be reading about recessions, but this is more like a natural disaster. It doesn't bear any resemblance really to a normal recession. So the tools for analysis that we would typically use, they really don't apply under these circumstances. So that's
let's talk about that. Yeah, that word recession, right? So it's a scary word. And I mean, I think there's a very traditional way of looking back to define something as a recession. So, you know, how do people manage that? And so talk about that. How does someone normally, you know, define something as a recession, and what does that mean for us now?
Sure. Well, typically we date recessions as 2 quarters, basically 6 consecutive months of GDP actually in decline. And it's the National Bureau of Economic Research that collects those numbers and typically calls the recession, and it can't do that until you've seen at least 2 quarters of consecutive decline. So that's the traditional way to measure a recession. I don't think there's any doubt right now that we're in a period of severe economic decline. The real question is, does it last 6 full months? Whether this is defined as a recession or not it will certainly economically define an entire generation in terms of how they perceive the risk around the world going forward. And I think that's an important thing to talk about in the weeks and months ahead. How does the economy adjust to this new reality? Whether you're in a recession, a depression, or just an all-out panic, I don't know that those terms really mean anything. We really have to think about this more as a natural disaster, and then you can tailor your economic responses to the economy more appropriately than you would in just a typical recession.
Yeah, that's a good point. It's a good point. It's thinking of it, this is something that's totally different and it's a different animal. And then I just wanted to circle back to something we talked about last week, because last week they had just put in place the package, and we talked about those small business association loans, the SBA loans, and there was some question about whether or not the 500 employee limit would include independent contractors or not. And I think you found out a little bit more about detail about that.
Sure. Well, when you look at those SBA loans, the bill was passed very hastily last week, and the program is scheduled to begin to roll out today. There's a lot of concern that banks haven't been given a lot of guidance. So the latest that I've seen from the big banks, the Bank of Americas, those kind of big banks, they are, number one, limiting the loans to their current employees, their current commercial employee, or excuse me, their current commercial clients, who already have some sort of lending relationship with them already. So if you're a small business or an independent contractor or someone who's self-employed, because these loans do apply to all of those categories, you have to have some sort of relationship already, or you're going to be way far at the back of the line. And these are first come, first serve loans. That being said, in terms of the independent contractor question, when you calculate your payroll, independent contractors do not count. And the idea sort of behind this is that independent contractors can apply for their own loans. And so they're not going to be counted in the payroll calculations of a typical small business. Independent contractors, however, cannot apply for the loan until April 10th. So they will certainly be, the smaller you are, the farther you are in the back of the line this time around.
Got it. Okay, that's helpful to clarify. And I think the important point around independent contractors and business owners too, it also is going to spill into our mortgage conversation, because Matt, we covered some of that too yesterday. And also I think, clearly employment and mortgageability are correlated, right? So can you kind of first comment about what you're seeing with tightening in the underwriting guidelines?
Yeah, there's a lot of changes going on. It's really fluid, but I kind of put in a couple different buckets, underwriting guidelines. So you look at it about agency. When I talk about agency, I talk about conforming loan limits, Fannie Mae, Freddie Mac. Then you have the government loans, FHA, VA. So I'll start with, and then you have jumbo. So we'll start with FHA, VA government loans. So right now, FHA, VA, it's status quo. Nothing has changed whatsoever. FHA put out a guideline that said, please make sure that the income that they're getting, you can justify their income they're getting regarding unemployment. Then you go to the next bucket down, which is agency, Fannie Mae, Freddie Mac. There's couple of different things we're looking at. They really tightened up on the income. So we need to see, in mortgage today, there's a thing called ability to repay a loan. So when we're doing a loan, we have to make sure somebody always has the ability to pay that mortgage. The first thing we look at is income. So we could look at income and then assets. So income first is you want to make sure that somebody 10 days before they're closing, we always do what's called a verification of employment. We've always done that. Conforming loans, no big deal if somebody's working for somebody. Today, Fannie and Freddie really loosened the guidelines. Used to be we'd have to get a letter from HR, or we'd use an automated system to verify that. But now we know everybody's working remotely. So even if we get an email from somebody's boss, that will suffice that they're still fully gained and employed. But somebody's going to have to sign an affidavit. Have to sign an affidavit saying, hey, I'm fully working. I don't see my employment going down. This is not going to be a problem. So for instance, if somebody's working, I had somebody who was relocating the other day and they're working for a large clothing company and they got furloughed. My heart breaks for the person. Furloughed, not to collect unemployment. Well, guess what? The ability to repay your loan because you're furloughed and now going to be on unemployment is you're not going to be able to pay that loan. So we're going to have to deny somebody in that situation. So it makes it really tough. The second piece is self-employed. So if somebody's a contractor, self-employed, it used to be that 120 days out, we check their self-employment, we check their tax records, look at all the information, run it through underwriting, we were okay. Now, up to 10 days before they close, 10 days or less, we're again verifying their employment, that it's solid, they've signed an affidavit, that things are moving forward. So there's a lot of scrutiny around unemployment.
Right. So it went from 120 days to 10 days. That's a big deal.
Yeah, 120, then to 30, and then to 10, so 10 days or less. And the underwriters have to be very creative because you have to make sure, right, we're giving somebody they're self-employed, that they have that, again, that ability to pay that loan back. So there's a lot of stress on underwriters. We're being very creative. We're calling, making sure phone numbers still work, looking for invoices, making sure they're still functioning in business. And then a lot has changed around assets. So think about it. When you're qualifying for mortgage, you have your debt to income ratio and you have certain assets that you have to have for reserves. So I'll just put hypothetically. So say to close on this big mortgage, you needed $100,000 worth of reserves to make sure you could continue to make your payments. If you showed me a stock, we 2 months ago, you said, here's your stock. This is what I make in my assets. Not liquid, it's in the bank, but this is what I have in stock. And we needed 100,000 to qualify. Well, and you showed me that you had 110. Well, chances are what's gone with the stock market, you're not going to have that. So we're going to have to ask for more of your assets and your stock portfolio today to see what it is today, just to make sure you qualify. And then you look at jumbo, what's happening in guidelines on jumbo. There's been a lot of tightening in the jumbo space. Where people had programs that would be 10% down payment, you're starting to see people go to 20% down payment or higher. Some banks are increasing the down payment reserves. And then again, around the same income assets, we have to make sure that they're really solid. So you're seeing a lot more regarding down payments. A big lift on guidelines has been on appraisals. Fannie and Freddie have both said, used to be whether it's a full appraisal, a desktop appraisal, or an outside appraisal, we can accept either. It's really up to your borrower or your client what they choose. So sometimes you want to have a true value, you still want to have a full appraisal. If you're trying to buy a home and somebody's not going to let somebody in the home, we can say, okay, we can do an exterior appraisal or a desktop appraisal. So it's really, all the agency will take either. Most jumbo lenders still want, depending on the down payment, still want a full appraisal, most jumbo lenders, or at the minimum, they're going to want an exterior only appraisal.
You know, it's interesting because as you talk about it, it makes me think about the concept of risk. And Marcy, we've talked a lot about that too, right? And sort of the fact that risk is really what's driving so much in the economy right now, and I think it's really driving a lot of what's happening in the mortgage business right now too. And the correlations are I think really strong.
Well, and I think you're entering into what I will call the unintended consequences phase of this crisis. And typically it takes months to get to that, where you start to see dislocations in markets, you start to see things happening that are sort of counter to what policymakers are intending. And we're already seeing that happen in mortgage markets, right? Where you've got issues around the Fed taking an action in one part of the market that's causing dislocations in other parts of the market, just at a time when the Federal Reserve is attempting to loosen credit to the economy. Matt has described a situation where banks are taking steps to actually tighten credit to the economy. And that might make sense for their long-term viability, but it's clearly at odds with everything policymakers are trying to do right now to keep credit moving. One of the things around the employment numbers, for instance, is that the cutoff for requiring paid leave is at 50 employees, right? So any business who has between 50 and 500 employees now is required to provide some sort of paid leave. Now, this is short term, it's only going to last during the crisis, but if you're a company that has 55 employees, there's a good chance you're going to fire 5 of them or 6 of them to get yourself underneath the cut. So that's an unintended consequence of a legislation that was attempting to help people that can actually mean that they lose their job entirely. I think you're going to see that happen in credit markets as well, where in attempts to loosen credit, you get dislocations in other parts of the market. And the Fed is going to be just sort of putting out fire after fire after fire, probably for the next 3 to 4 months until credit markets get back to normal.
So do you think that number, when people need to get under 500 for numbers of employees in order to qualify for these loans, do you think that's part of what drove the unemployment rate?
I think it probably a small piece of it. I mean, what's really driving this is that you've got restaurants and hotels that have no business whatsoever, and they're businesses that can't go to remote working, and they tend to be labor intensive rather than capital intensive. So this shock to the economy is hitting, by definition, your most labor intensive sectors. And so the biggest numbers, the biggest dislocations are going to happen in anything related to labor. You know, it's sad. And I do see policymakers with extending unemployment benefits very generously. Again, this leaves employers saying, well, I could keep paying my people, but if I lay them off, they're going to get very generous unemployment benefits, and they'll come back to work for me when this is all done. So it doesn't change what policymakers should do. We just have to be aware that it could be making some of the numbers look worse than they really are.
Got it. It's a good point. Let me circle back, Matt, to you about that risk topic again, because it's interesting. There's something unique going on in the mortgage ecosystem right now that means that servicers of mortgages have potentially more risk. Could you talk a little bit about that and how that all kind of works within mortgages?
Yeah, it's really the unintended consequences, especially when everybody said forbearance. You hear the Governor of New York, Governor of California saying, oh, we're asking all lenders to do forbearance on payment. So forbearance means we're just basically, you're going to still owe us the payment, right? And we're going to hold, 90 days with no payment. So what the unintended consequences are, if I'm a bondholder on the so mortgage is an investment tool, right? So you have a mortgage-backed security. I sell a mortgage-backed security. I'm the servicer, right, today. So as a bank, we service the loans. So we hold stuff on our balance sheet, a section of it. So just talk about jumbo mortgage, we hold them on our balance sheet, and some we sell as an investment tool. An investment tool could go for teachers' pensions, let's say, or insurance policy. Well, when the government says you no longer have to make a payment for 90 days, and we still have to figure that all out, it becomes like, oh, how are we going to do all this? You say somebody still has to pay that bondholder because the payment is still due because it's still an investment tool. So we still haven't figured it out. So from a servicing perspective, today for something like forbearance for Fannie and Freddie, yeah, we're kind of figuring that out. That's not a risk. But when I have stuff on my books and somebody says we're no longer going to be responsible for payment if you have these hardships, we have to absorb what that payment should be and figure it out on the back end because the payment still needs to be made on by somebody. On the flip side, where you saw a lot of lenders that were in that jumbo space, they're at risk of going out of business because they still have to make that payment to somebody. So you saw a huge contraction on correspondent lenders. So like a Redwood Financial or some big companies that would do these type of mortgages. The bondholder was due, somebody still needed to make the payment, even though people weren't making the payment. So there's a lot of the markets haven't figured it out yet, and it will all come back. So it might put it's putting people trying to figure it out. So back to Marcy's, there's a lot of unintended consequences of how we're going to process it. We know the government's saying we're going to do forbearance programs. We're doing it as a bank, 90-day forbearance programs, but you still have to qualify for the forbearance program.
Right. So it's not like Marcy, it's not like our brokers should recommend their agents should apply for forbearance to conserve cash because they still have to qualify for it.
Yeah. So, and the qualification for forbearance is, and every lender is going to look at this a little differently, but you have to have a hardship. Has your income been reduced? Have you had a job loss? Have you been sick? Do you have medical bills? We have a whole form. So if you go on our website, you can go in and see the form, and then it has to be approved. But just think about it just from I know our shop, we service a couple 100,000 mortgages. And I think the number was 30,000 people when we opened it up on Monday, applied for forbearance and filled out the application. Just to go through 30,000 applications is mind-numbing, right? To make sure that that's approved and kind of catch up. with that.
Got it. And sorry, Marcy, what were you going to say?
No, I just was saying that Matt's pointing to that larger issue that we've talked about every single week, which is that cash flow really matters here. And if you want to look, the efforts are to basically keep solvent businesses who are just illiquid from becoming insolvent. And that's really the crux of what's going to matter in every single industry everywhere, for individuals and for big companies. What's their balance sheet look like? How much cash flow do they have? How long can they hold out? So if you look at the S&P 500, the average company in the S&P has 7 months of operating expenses. But for a servicer, that's not an operating expense, right, Matt? We're not talking about operating expenses. We're talking about something much, much larger.
Yeah, and there's a difference between a monoline lender, right? Because we're operated differently, and a bank, because a bank we have to plan for rainy days. One thing that I think is good about this is the financial crisis that we dealt with. I'm still amazed how fast the legislation moved and they were able to pull the triggers. So we have banking calls. It's just amazing how fast we're trying to stimulate this economy and put things in place. But Marcy, you said it before, excuse my friends, it is a shit show because we're still trying to figure this out, how to do some of this stuff. Like, yeah, we want to, before the call. I apologize. I'm from Jersey. I'm allowed to say these things. But it's amazing. We have these policies taking place. They're great, but now we have to figure it out. So for like SBA, we have people calling the bank. Well, we're not an SBA lender. So what we're doing is saying, hey, you have to be set up for SBA loans. This is the bank you need to talk about. So people think, oh, you're a bank, you're going to give me money. And we're like, oh, it's not that simple, because you have to have, again, that infrastructure to deal with it. And I'm worried. I just look about, we'll talk about rates. Everybody said the Fed cut to zero. Well, mortgage rates aren't pegged to the Fed. It's on the 10-year Treasury note, right? But then there's a thing called supply and demand. So the 10-year Treasury is under 1%. Rates should, today are in the low threes. But a week ago, our phones were ringing off the hook because everybody heard the Fed cut rates. If you went to the big bank websites, they're publishing 4% rates because they couldn't handle the volume. So the only way to throttle the volume was supply and demand, was increased rates. So Wells just put out a thing. They think rates are going to be under 3, right? In the high 2s. Right now, they're in the low 3s today. But people just don't understand the supply and demand. So we just get hit with so much demand coming in, and people want to refinance. And I think that's going to be with this SBA program, is how do you handle all this demand into the system when I can't handle the demand we have for refinances today.
Well, and that refi means you got problems for loan servicers who thought they were going to hold those that need 3 years to break even, I believe, roughly on an average loan.
Yeah, so there's servicing release values and servicing release premiums. So we get a premium that when we're doing modeling and what we're going to price out a loan, there's a servicing value, right? So you say, okay, it's going to take me 3 years to break even, right? Or some mortgage companies will sell the servicing, have somebody else service it. So it's how much we can hold on to our portfolio of business and to recapture that. So there's a lot of pieces moving. And it's basically how we justify the model. It's just going to be a huge refinance boom right now. Primary Mortgage Market Summary, which Freddie Mac puts out every week, the national average on Thursday was 3.3% on a 30-year fixed and 2.82% on a 15-year. So, and I just think because the demand is so high, the rates still are going to come down lower, right? So this is going to be a time we're just going to see a huge, huge refinance boom.
Matt, you touched on jumbos earlier, but you could talk a little bit more about the sort of unique things that are happening there, because people are, already finding that they're harder to get.
Yeah, so we've seen a big pullback on jumbos. So if you call, and the largest lender in America now is Quicken Loans. I've been told Quicken Loans won't even quote a jumbo rate, right? When you're a monoline lender, you have the way to get to a jumbo or a broker, you have to go through what's called a correspondent channel. So the big banks have correspondent channels where they sell to the brokers and they have to meet the guidelines, right? So if you look at somebody like Wells Fargo announced they're not going to do correspondent loans in the jumbo space anymore. They're going to have to come to Wells Fargo directly to get it. We have a correspondent channel. We've greatly reduced our risk portfolio of what we're doing for jumbo loans. So you're seeing people that are monoline lender that just do lending that do not have balance sheet capabilities like a bank have to go to other banks to get their mortgages. That's really slowed down a lot and they're having trouble. So we're seeing people come for jumbos basically directly to the bank. So you can still get a jumbo today, but down payment requirements might change. You're not going to see variances where we would say, our variance would say, just an example, to do a jumbo, you need a 680 credit score to do a jumbo loan. Well, if somebody was a 670, but they had a ton of money in the bank and it made logical sense, would say, yeah, let's ask for a variance and can we do this? You're going to see a lot of the variances change and nobody's going to make the exceptions because people are just afraid of uncertain times and what's going to come up next. And those jumbo loans have to stay on somebody's balance sheet because today there is no market in mortgage-backed securities to package them and sell them.
Right.
So it's going to stay on a balance sheet.
Right.
That makes sense?
But good, it does. But it's good they're being conservative about it too, right? So that's sort of how we got in trouble before. Part of it, anyway. Yep, Marcy, you have something to comment on?
Well, I did want to say, banks right now have $1.8 trillion in excess reserves, not required reserves, but basically excess reserves those excess reserves are just extra money that's available to lend out. But over the last 10 years, they've been building up those excess reserves. Basically, while they had no idea that something like this could happen, they knew that a 2008 could happen, and they had no real excess reserves then. So the banking sector in general is in a much better position to weather something like this. So once they sort of, find that things start to normalize, the money's actually there. They're just choosing not to loan it out right now, but it doesn't mean the money's not there the way that it did in 2008, 2009.
Yeah. Good point. Thank you. Yeah, and that's what we talked about in the past about liquidity, and it's just a different environment than it was before. So, and I'm watching the questions.
I'm sorry. One thing that's going to be interesting to watch is to see what happens with home equity lines. So a lot of people have home equity lines. And you remember in the financial crisis, banks started pulling back on HELOCs, right? I think we're too into this to know if things are going to normalize. But that's one thing that people have billions and billions and billions of dollars with unopened home equity lines. So if you start seeing people just drawing on their home equity line, sticking their bank for a rainy day because those rates are so low, I'm very interested to see what happens in the home equity line sector.
Interesting. Well, and maybe we'll have to have you back and to have you comment about that in the future as we continue to watch this.
Yeah, and I should put a caveat because what I say today might change tomorrow because weekly these things change. So
yeah, I was going to say we're running into that week after week, and that's part of why we've continued to do these because everything changes significantly. And in fact, Marcy, there's a question here for you because someone said, do you really see things back to normal in 3 to 4 months when everything else we're seeing says 1 to 1.5 years? And I just wanted you to comment on that.
Sure. Actually, I still fall into that optimistic crowd because optimistic in that once we either have a vaccine or some sort of technical way to track community outbreaks, and again, I'm not a scientist, so I don't comment on the likelihood of those things. I'm reading the same things that everybody else is reading about the science of all this. But one of the things we know is that if there was a vaccine developed tomorrow, which is not possible, but if there were, then things would go back to normal very, very quickly. So we have to keep doing that thought experiment. It isn't that there won't be continual fallout. There's going to be lots of unintended consequences. But again, I've said over and over, this isn't a normal recession. Normal recessions require a reorganization, a permanent reorganization of economic activity. And while I do think that there's going to be a heightened risk sensitivity that makes people save more money over the long haul, which means they consume less, sort of in equilibrium, I do think the economy pretty much goes back to the way that it was, I think much faster than a year and a half, 2 years, because you don't get the bank failures. And it was the bank failures that really caused the dislocation, not just in 2008, but also that's what the Great Depression was about as well. And that's why I say that that 1.8 trillion of excess reserves in the banking system, it's really important right now to understand how quickly things could go back to normal.
Well, I know that we can count on you to keep watching a close eye for all of us, and we'll be back here in a week to do an analysis of what's happened in the next 7 days. And Matt, you're certainly welcome to join us, and we'll probably have you back in the future to continue to keep an eye on what's happening with mortgages and the impact of the overall economy. Again, thank you both. I think it's just really, really valuable to have your voices and your expertise and point of view. I'm just going to remind the audience that this will be posted on our Vimeo site at vimeo.com/leadingre. And that should be up later today. And then again, you can send questions. There were a couple questions we didn't quite get to, so we'll consider those for next week too. And thank you both for your time and insights and expertise, and please stay safe. Thank you.